Howdy, Jacob here. Today we're looking at Douglas Dynamics, ticker symbol PLOW. All right, so machinery industry, $590 million market cap, $765 million enterprise value, a little bit of net debt here, 4.6% dividend yield. Looks like besides 2020, return on invested capital has swayed between maybe 7 and 13%. So that's pretty solid. Growth looks absolutely fantastic. 194 million in 2013 up to 616 million in 2022 with only COVID being a down year. Outside of 2020, we're looking at very consistent, very positive growth. What do they do? Operate as a manufacturer and outfitter of commercial work truck attachments and equipment in North America. Founded in 1948. That's an older company. Why their growth is so much recently. Interesting. So free cash flow, they pay out 27 million for dividends. They've only bought back shares 1 year. Otherwise, looks like they use their money to buy back a little bit of debt, very little for acquisition, none the last 5 years, and then pay a dividend. Let's look at that balance sheet. What are we looking at? 21 million in cash on hand, 195 million in long-term debt. Looks like they might have made some sort of acquisition between 2013 and 2016. Used funds from debt to do that. Yeah, okay. 2016, $181 million acquisition. They went into debt 127 million. I mean, balance sheet looks reasonable. 195 million in long-term debt and 5 year average, maybe 50 million, 40, 45, 50 million. 5 year average free cash flow. That is about four times a 5 year average free cash flow for the long-term debt. That's reasonable, and the fact that they're paying it down is great. Looks like a $27 million payout is it's all right. It's maybe a 60%, 50 to 60% payout ratio. That's reasonable. Let's look at their history of dividends. Looks like they increase it about 2% a year. I think I'm comfortable making that assumption, keeping that pretty consistent. I think their payout is reasonable, and um, return on invested capital isn't crazy, and it doesn't look like they're reinvesting back in themselves that much and making using a lot of money for acquisitions anyways. So last 5 years, we're really seeing free cash flow just go towards debt and dividends, which is fine. Nothing wrong with that. You just got to know that. But their growth has looked pretty great. So it should be interesting to see what we get here. Maybe on the revenue side, we'll see a 6% growth, and then at the end of 7 years, sell for roughly 15 PE, saying that yeah, there's more growth in the market ahead of you. So that'd be a positive sign. Their margins have gone down. Gross margins were 34% in 2013, down to 25% in 2022, and then roughly 15% in 2013 for operating margin, down to just under 10%. So I don't like to see that. I'd rather see, a flat business that's improving their gross margins and their operating margins to me is better than a company that's just growing revenues like crazy and decreasing margins. To me, that's saying they need to lower prices to sell more product, which can be fine. I mean, in the end, but it gets to a point where your ability to grow is then hindered, and then maybe that destroys the type of company you have. But let's see, 6.8, 9%. I like that free cash flow appears to be consistently higher, but their margins have been going down. Maybe let's assume 6%, 7%, no share changes. All right, not too far off. Let's see. It looks like the company's stock price would have to fall 28% to get a 15% return given these assumptions. Yeah, I mean, to me, the current yield of 4.6% seems reasonable. It's less than a 60% payout ratio of their 5 year average free cash flow. I mean, the business is growing like crazy. The only things that I don't like, debt is fine. It's about four times their 5 year average free cash flow. I think that's reasonable. I think their dividend's reasonable. I think increasing that 2% is fine. I think that the main thing I don't like here is margins going down, both gross and operating margins being decreased quite a bit from where they were 10 years ago. I don't like to see that as much, but I think this is definitely a company I would add to my dividend yield screener. I think that this could be a company that is attractive, and their dividend yield being over 4% right now, I don't see that going away. Well, I mean, the price could just shoot up like crazy, but if you want to buy at a more attractive price, given the fact that they don't decrease their dividend payout, that's just going to increase the yield. So to me, I think this could definitely be a decent company to buy for your dividend yield portfolio. And right now, I'm just waiting for the price to get more attractive so I can get that price appreciation along with the dividend yield. But yeah, I hope everyone enjoyed the video and has a great rest of the day. Thank you.